Hello everyone, welcome back to our new video. In the last video of this mutual fund series, we had discussed about what are mutual funds, what are the different types of mutual funds, and what type of investors should prefer investing in mutual funds. If you haven't seen the video, I'll put the link in the description below. Now in today's video of this mutual fund series, we are going to discuss about how to select the best mutual funds. Now today there are more than 2,500 mutual funds and there are various schemes going on in the market. But we actually need only 6 to 7 mutual funds to build wealth. So now the point is, how are we going to select those 6 to 7 mutual funds? This is going to be very interesting. So hang on in the video till the end, as we are going to dig deep into understanding on what basis we can select a mutual fund. Now most of us select a mutual fund on the basis of past performance, but past performance doesn't give you an assurance of the same level of performance in the coming future. An equity fund gives good returns under two conditions. Number one, when equity market does good. Number two, the stocks in which the fund has invested its money does good. So in today's video, I am going to discuss those factors which need to be considered while selecting mutual funds. So let's start. The first factor that need to be considered while selecting a mutual fund is your investment goal. Your investment goal has a big role to play while selecting a mutual fund for your investment. Your goals may be short-term goals and long-term goals. Short-term goals are the ones that you want to achieve in a time span of 2 to 3 years, like for example buying a car or saving for your marriage expenses. Long-term goals are the ones which you wish to achieve in a time span of 8 to 10 years, like saving for your dream house or your children's education. If you are investing to achieve your short-term goal, then the best mutual fund option available is the debt fund, as debt fund gives you a fixed amount of returns. Investing in equity mutual funds to achieve your short-term goals can be risky, as in the short term market tends to be highly volatile. So you can experience lots of ups and downs in short term, which can be risky. On the other hand, if you're investing in mutual funds to achieve your long-term objectives, then equity mutual funds is a great option, as in long term markets most of the times give you positive returns. In fact, my personal opinion is whenever I invest with a time horizon of 10 years or more, I prefer investing in equity mutual funds, and under equity also I prefer investing in the mid cap and small cap mutual funds. No doubt they are highly risky, but because my time horizon is 10 years and more, I believe that market has always given a positive returns in such a long horizon. So whenever you want to select your mutual fund, first you have to define what your goal is and why are you investing in mutual fund. The second factor that needs to be considered is the alpha of mutual fund. Now before understanding what is alpha of mutual funds, first it is important to understand benchmark. Benchmark is a standard used to evaluate the performance of any fund. Comparing the fund with a benchmark gives an idea of how well the mutual fund is performing in comparison to the benchmark. Now the alpha of mutual fund tells us how well the fund has performed when compared to its benchmark. Say for example, if the alpha of a mutual fund is 4, it means the mutual fund has given 4% more returns compared to its benchmark. On the other hand, if the alpha of a mutual fund is minus 3%, so it means the mutual fund has given 3% lesser returns compared to its benchmark. This means the fund has clearly underperformed. Now there are very few funds in the market who are able to beat the benchmark. So it is always recommended to select a fund with a higher alpha, because these funds have performed better than the benchmark. The third factor that needs to be considered while selecting a mutual fund is the beta of a mutual fund. Beta indicates how volatile the fund is compared to its benchmark. Now, higher the volatility, higher is the risk involved in investing in mutual funds. So if a fund that you have selected has a beta of more than 1 means the fund is more volatile whenever the market fluctuates. So this means when the market goes up, the NAV of this fund sharply rises, and when the market comes down, the NAV of the same fund sharply comes down. So no doubt such funds tend to give you higher return on investment, but the risk involved in these funds are also high. However, on the other hand, the mutual fund which has a beta less than 1 are less volatile when market fluctuates. So it means you have got a good downside protection. Means when the market goes up, the NAV of this fund will also rise, but not sharply. Plus, when the market falls down, the NAV of this fund falls, but not sharply. So such funds are less risky. They may give you a moderate return on investment, but it's less risky. So now, if you are ready to take higher amount of risk, then you can select a mutual fund with a beta of more than 1. But if you don't want to take higher amount of risk, then you can select a mutual fund with a beta of less than 1. The fourth factor to be considered while selecting a mutual fund is the duration for which you are investing and the amount of risk that you are ready to take. Now there are two things over here. Number one, the duration part, and number two, the risk part. Now what is risk? I'll try to make it easier for you to understand. Suppose you invest ₹100 in a mutual fund. Now there are two possibilities over here. Either the price may go up or the price may go down. Suppose if the price goes down and your ₹100 investment depreciates to ₹95. So you are incurring a loss of ₹5. So you are ready to take this loss of ₹5, and that's a risk that you are taking. Seriously speaking, the mutual fund that you select greatly depends on the duration for which you are ready to stay invest. Now your goal for which you are investing and the duration are greatly interlinked to each other. Let us understand this with few examples. If your goal is to buy a car in next 3 years, then the duration for which you want to stay invested is obviously 3 years, which is a very short duration. Always remember that if you are investing for a period of 3 years or less, then your investment has to be in debt mutual funds. This is because in such a short span of 3 years, the market may tend to be highly volatile, due to which you may have to face a loss. Investing in debt mutual funds will assure a fixed return on investment, thereby keeping your capital safe. You can select any of the mutual funds depending on your duration of investment. If your duration of investment is 6 months to 1 year, then you can select a liquid mutual fund or ultra short duration fund or low duration funds. If your duration of investment is between 1 year to 3 years, then undoubtedly you have to go for debt funds because they assure you a guaranteed returns. If your duration of investment is around 3 to 5 years, then equity mutual funds turn out to be the best option. Also in equity mutual funds, according to me, mid cap fund and large cap fund can be a very good option. Now, if your investment duration is more than 6 years or for that matter, more than 10 years, then according to me, the best investment option is equity mutual funds, and under equity, I would personally prefer the mid cap and the small cap section. No doubt they are more risky, but higher the risk, higher is the returns. Plus, when I'm investing for a period of 10 years, I have got a large amount of time, and in such a large amount of time, my risk factor decreases sharply. The last factor is the expense ratio. Expense ratio refers to the amount of money that the mutual fund company spends in order to maintain the fund. This includes the salaries paid to the fund manager, salaries paid to employees, money spent on research and analysis. Now the amount of expenses incurred by the fund is deducted from your investment. Ultimately, expense ratio is a cost for you as an investor. So a fund with a higher expense ratio means higher the cost for you, and higher the cost leads to lower returns. On the other hand, lower expense ratio means lower the cost, and for you, lower the cost will result into higher returns. So ladies and gentlemen, guys and girls, these are the 5 factors that you need to check out before you select any mutual fund. I hope the video has been informative and helpful for you. That's it for today. Here is Rohan signing off. Bye bye. Jai Hind.